next time you're on the program, we're going to do another session on how you value a company, right?
Well, that's in a fortnight.
In a fortnight's time, on a Thursday, fortnight's time. So people want to be, there recording it, hang on every word. We're going to do that.
Get a pen, write it down. I'll do it all.
Okay.
No problem.
But you also said there are 3 things that you think people need to deal with. Now, we've got about 6 minutes left. Is that going to be enough to deal with the 3 things you think people should get right to buy stocks effectively this year?
Yeah, look, step number 1 is you need to think correctly. And you need to, what I mean by that is you need to think about the market as not as this omniscient being that is wise and it has all the information and it correctly values stocks.
Perfect market.
Yeah, correct. Doesn't exist. Yeah. And so instead of thinking that the market's right, and I know a lot of people do this, they buy a share and immediately goes down and they think the market knows something I don't, and therefore I better sell it and get out because clearly I'm not as informed as everybody else. Well, people are selling shares because they've got to renovate the bathroom. They're selling shares because they've got a tax bill, and that's moving share prices around. So on any given day, something could be happening in Iraq or something could be happening in Greece.
Or a hedge fund could be short in the market.
Exactly, and it's got nothing to do with the performance of the underlying business. What you need to do is think about the market correctly, and the way to think about the market is not to think about it at all. It's to think about businesses.
The company.
Think about the company and the business and whether it's a good business or not, and that's the second step. The second step is it a good business or is it a bad business? And the way to identify a good business is basically, and there's a fair bit more than this, but in summary, a high return on equity, little or no debt. They're the sort of things that you want to look for first.
What are the calibre of the CEO? Do you ever throw that one in there?
Do you know what? I've got the view that the boat you get into is more important than who's rowing it.
Gee.
That's been my experience. I think if you get a great boat and a great rower, then away you go.
I was just thinking that the drunken blind sailor would worry me just a little bit.
Exactly. Yeah. And think about a company like Qantas. Lousy business, terrible business. It's destroyed billions of dollars over the years, and yet it had a great rower rowing it. Now, I suspect if
Jeff Dixon. Yeah.
I expect if Jeff Dixon was in a boat that wasn't perpetually leaking, he would have done a terrific job for shareholders. I think he did the best job he could, but he was in a leaky boat. So,
would you revisit Qantas on your current calculation?
No, I would never own. If you ever hear me say I'm buying an airline, I want you to take me out the back and and really tell me off, because there's no reason.
I'll do it on public television.
Let's do it here. Let's do it here.
Okay.
So I should never have any reason to own an airline. They are very, very bad businesses in terms of their performance. And even if you look at the global body that represents airlines, they came out with a report only recently to say globally it's lost. I think they lost $5 billion last year, and they're only going to lose $4 billion this year or something like that. Collectively, bad businesses. So you want to buy good businesses, not bad businesses. And step number 3 is you want to know what they're worth. You want to work out their value. Now, all these sheets I've got here, Peter, these charts
looks like
that you can see,
double Dutch to most people, but it does show you a lot.
It tells me a lot, and I've done it so that I understand it and I know what the values of these businesses are. Telstra, if you look at Telstra, the value of that business hasn't changed in 10 years. I don't want to own a business that isn't going to go up a lot in value. I want to own a business. I want to own a business rather that is going to go up a lot in value, not one that goes sideways.
Well, I got you there. Name one that's in that category,
that's going up?
And tell us why.
Okay.
You tell us why Qantas isn't a good buy, and Telstra's not a good buy.
Okay.
Tell us what is a good buy and why.
I love it when you put me on the spot.
Yeah, why not?
And
you wouldn't be up to the task.
Well, I now have confidence to know that I can answer all these things. But it's taken some years of experience. All of the banks are an example. Have a look.
So all the banks are buyers.
We need to put these. We need probably to put these on the screen next time I'm on.
We will.
But look at they're all going up in value over the next few years. Why is that? Inertia. Banks charge you to put your money into their account. They charge you to take it out. They charge you to check what's in there. They charge you to get a statement. They charge you for everything. And the great thing about them is people don't move. People just think, oh, it's all too hard. They're entrenched into your daily life. You've got the card, you've got the account, you've got your PIN number, you've got your log on the web. People don't want to switch all that across. And if you've got a business and plus personal accounts, the last thing you want to do is change banks. So it's a really big deal to change banking, all your banking. And so banks can collectively charge what they like, and people just say, oh, well, aren't banks awful? But we just keep paying them. And their return on equity is generally pretty good. Yeah. The CBA, I have to admit, is a lot higher than the others.
Okay, and so all 4 banks would pass the very stringent Roger Montgomery test?
I think in terms of performance, the best bank is the CBA, but it's now the most expensive. It was about August
People
last
have been
year.
listening to you for too long, I know.
Yeah, so you might remember I said CBA was the best bank, and it's done the best, and now its share price, though, is expensive. The other banks, their performance isn't as good, but they're cheaper compared to their intrinsic value. And all of them, their value is going up over the next few years.
Roger, as always, very informative. Give us 4 very good companies to follow, and see you in 2 weeks' time. And we're going to try and really understand, because sometimes viewers say, I love what he says, but I don't fully understand. We have to dumb down Roger Montgomery.
And there's a book coming too, I should say.
Okay. Well, we should publish it for you.
All right, well, you can help me.
Okay, mate.